Welcome to Venture in the South. These are the stories of innovation and success in the southern U.S. that make money, have fun, and do good. This is David, and I'm here with Paul, and we're going to be talking about a recent data release called The State of Startups in the Southeast from BIP Ventures. And they're a fund operator in the Southeast, and they release this report annually trying to distribute information to both investors and founders about the state of the startup market. And we generally find it interesting, and so we thought we would talk about it a little bit. And so, Paul, tell us what's in this report.
Thanks, David. Yeah, this report comes out every year. I think this is the 8th of them since they began in 2017. It is a synopsis of an analysis of the deals done in the Southeast, defining the Southeast as the states from Mississippi over to Virginia. BIP Ventures is part of BIP, which is a Atlanta-based wealth manager and early-stage investor that collates all this data and tries to give a sense of what's been going on in the market in the Southeastern startup and investing arena.
Yeah, and so it's useful because, and we talk about this intermittently, about how the Southeast is different than the West Coast and the Northeast. And so it's useful in the context of we're different than these other big markets. And so some of the behavior is different.
That's right. Yeah, it's useful for a number of reasons. We can talk about how people use it in a bit. Definitely would like to go through the trends that it highlights and the ways that those are different in the Southeast versus some national trends we've talked about before.
Okay, go for it. What are the key trends?
Well, so the key takeaways, I think, are in terms of investing activity, whether that goes up or down year to year. And the trend in 2025 so far is it's going up. So it looks like about a 33% increase in deal activity between 2025, the first half of 2025, and the same period in 2024. So that's good. A bit of a recovery from the post-pandemic slowdown. More activity seems to be going on. Which is true nationally as well, but I think continues the general trend that the Southeastern trends are more muted than they are nationally. The excessive bubble in the pandemic period was smaller in the Southeast. The recovery was lower in the Southeast than it was nationally. And kind of the uptick in activity in the last year or so, again, is lower than the equivalent uptick in the national trends. So that's always interesting to see how the Southeast is just generally more muted. There are a few outliers, so that tends to skew the data. In other places, we have maybe a more boring set of companies, but a more consistent and fewer outliers that make the trends more dramatic in the Southeast than they do in other areas.
Yeah, the investments in the Southeast are more angel investment type investments as opposed to venture capital, big fund type investments that are swinging for the fences. We don't really have those kinds of companies in the Southeast very often. Occasionally, but these swing for the fences companies that have big support from venture capital, they tend to relocate to the West Coast because that's where the money is. And so that distorts the market. That even if they're from the Southeast, they relocate to Silicon Valley because that's where the money is. So the big plays we're just not seeing in the Southeast. One of the things that I noticed, I'm interested in your comments about this, is that while there was a rebound in capital deployment from the post-pandemic dumpster to now, that's been very nice. When you go back to the pre-pandemic levels, the variation has just kept pace with inflation. So there's not more capital being deployed now than there was in 2019. Well, there's a little bit more, but not a lot more. And it's parallel with inflation. And so it's not really, if you think of it in terms of pre-pandemic economic activity and current economic activity, it's just kept pace with inflation. It hasn't grown beyond that.
I mean, just keeping pace with inflation in the last 10 years has been a pretty good accomplishment given the rates of inflation. But yeah, I agree with you. I mean, the volumes and the value of the activity is not dramatically higher than it was pre-pandemic, which is an interesting observation in itself. That's true. It is also interesting to see the shift in some of the practitioners. So one of the interesting trends it notices is a consolidation overall, with bigger funds doing bigger deals, fewer deals, more follow-on rounds, later stage deals. And so some evolution a bit over time to later stage VC, which I think, again, is generally true and more muted in the Southeast than in other places. But interesting to see how that comes out in terms of some of the average deal sizes and some of the valuation statistics that the report comes up with, those feel a little odd to me sometimes. And it's because of the inclusion of much later stage deals and more much later stage deals than we typically work on at VentureSouth. And I think that you invest in and that angels in general invest in. And that does make the statistics sometimes seem a little odd to a really early stage practitioner.
Yeah, it's interesting to look at the check size over time, and it's clear that the check size has gotten bigger while the number of checks has gotten slightly smaller. And I'm not sure exactly why that is going on. Maybe you could speculate a little bit on that.
That is what they say. And I think maybe that is true, what is going on. I mean, it has been hard in the last couple of years for new small funds to get started. And the general national trend is all the money in VC is going into the top 10 biggest VC funds, and they're dominating the market. So I think that is overall a general trend. And I guess there is some of that in the Southeast. Yeah. On an individual practitioner level, I mean, VentureSouth's deal size hasn't changed in the last 5 years. And I think most angel groups haven't really either. It's just a bit of a mix in the market participants has changes what the deal sizes look like.
So if I understand you correctly, then you're saying that the larger deal size is largely attributed to the larger funds and that smaller investors are writing a similar size check that they've been writing.
Yeah, I mean, I think that's the case. I think there's some evidence of that in this report, and there's some evidence of that in other data as well. But yeah.
Interesting. Now, we have talked about a shift in the type of funds that we see in the Southeast and in the US in general. And we've noticed an increasing level of interest in this category of evergreen funds. And the report doesn't really address this heterogeneity in terms of fund type. And there does appear to be greater uptake, though I was disappointed they didn't talk about that in the report.
Ironically, because I think BIP Capital are one of the only practitioners of an evergreen fund in the Southeast. So it's interesting that they didn't mention that. They didn't talk much about what the investor types are in general. Actually, I do agree with you that I think that's kind of a weakness. One of the big weaknesses that's related to that I have in the report is they do a really poor job of categorizing different groups correctly. I'll give you one example. On the South Carolina analysis that they do, I'm pleased that they attempt to do state level analyses, but the conclusion they have on South Carolina is that the top 10 VCs in South Carolina generate twice as many deals as the leading incubators, angels, and government sources in South Carolina, which on the face of it is a completely absurd claim. Angels do 10 times as many deals as VCs. Incubators create far more companies than VCs. You can have a lot of complaints about the South Carolina investing environment, but we are overrun with VCs is not a complaint that makes any sense at all. And so that kind of conclusion in the report on things that I know makes me pretty skeptical about the rest of it. And the reason that they came to that conclusion on South Carolina is because, and again, I give them some credit for laying out the deals that are contributing to that, but they gave, in the venture capital bucket, they gave credit to a firm called SC Launch as a venture capital fund. And anybody that's even a tiny bit familiar with South Carolina knows that SC Launch is not a venture capital fund. They're a government financed through tax credits, state level investor.
Well,
So
they're
not a VC fund.
economic development.
I mean, they're for-profit focused. They want to make positive returns, but yeah, they're economic development funded and focused. And so they should be in the government bucket, which is another bucket that they have. And so if you remove SC Launch's 54 deals from the VC bucket, then the conclusion is the exact opposite of the one that the report shows. It's like, that isn't something that, anybody that has a passing familiarity with the South Carolina investing world would know that and could have told them that that's in the wrong bucket. And therefore their conclusion is wrong. And so I get that classifying investors can be hard, but putting them in the VC bucket and putting the entity called Gaingels, which is the angel group that focuses on LGBTQ entrepreneurs, in the VC bucket, just doesn't make any sense in South Carolina. So they come to the wrong conclusion there entirely. Similarly, in North Carolina, they put the Triangle Tweener Fund as a VC fund. It does have the word fund in it, but it's not a VC fund. It invests before angels invest. So it's like the earliest stage investor. It's in the wrong bucket. So again, it's skewing what kind of conclusions people are coming to. So I agree with you that they could have done more on types of funds and investors. And what they did do on that is pretty weak work, in my opinion, so far.
Maybe it's an opportunity to collaborate to strengthen their report.
It could be, yeah. I don't know that they want to do that, and I don't want to denigrate the report overall because I think it's a useful thing to have. I have some concerns about some of the data, and fundamentally it's based on pitch book data, which we've talked about on the show in the past, and I'm a skeptic of. It's generally pretty poor, outside of the key investing geographies. And so I think a lot of work has had to go into making that pitch book data usable for a Southeast report. And to BIP's credit, I think they've done a pretty good job of supplementing and improving that data. But it's a tough foundation to build a compelling house on when you're using pitch book data.
Yeah, maybe that's an opportunity for a startup, is to develop a pitch book for the Southeast or regionally based data provider that has deeper contacts and knowledge of a regional economy than PitchBook has. Because I would agree, PitchBook is completely inadequate in terms of regional economies and badly skewed by their focus on the West Coast.
Yeah, I don't know that there's a compelling business model to source and sell that data, but if you combine PitchBook and Carter and the ACA data and other research data, you can probably come up with a pretty good data set overall from what's available. But just relying on one does tend to give some potentially some inadequate coverage of all the deals that are going on.
Well, if you believe the thesis that data is the new oil, any kind of data that you can collate that reveals something that no one else has revealed has value. And I don't know how much value. There's value there, particularly in the growing scraping environment of AI, where more and more data sources are walled off from AI scraping, and so they have to pay to get access. And so it's an opportunity to sell.
It could be. And definitely the things like the state level analysis are unusual in this report. You don't usually find those things. And so there's some value to that data to buyers of it ultimately. So maybe you're right. I do think they need to just improve some of their data usage, data categorization and analysis there a little bit to make it really compelling, but it's a good start.
So how can readers use this report to make their investing better?
Yeah, I think actually it has a pretty wide audience. So for me as an investor, I'm interested in the overall trends in the market for sure. And it's got good content on that. I like the state level analysis. It's useful data for that. I do like the fact that they put in the league tables. So practitioners can brag that VentureSouth is the number one angel group in the Southeast by activity. So that's useful propaganda for some firms to be able to use. But it's also useful for you to sort of understand who the players are. So if you're raising money, then you can look at this report and you can find the names of the 100 investors that are likely to be on your short list or long list of people to reach out to. So I think it's useful for figuring out who the players are in the market that you're trying to raise money from or sending to. Founders, it's good to see who's active. I think it does a pretty good job of showing non-Southeastern investors too, and when they do investments in the Southeast, which is not always easy to find from other places. There are several investing firms on these lists that I didn't know who they were because they're not based in the Southeast. And so you can do a little tracking around who they are and which San Francisco, Silicon Valley investors are actually doing deals in the Southeast is a useful piece of data for founders to know as well. So that's how I think founders might find it useful. On the investor side, it has a similar good list of who the incubators and accelerators are. So if you want non-proprietary deal flow volume, you can get a lot of deals coming out of those incubators if you know who they are. It does have an interesting, although not super well analyzed, list of exits. So you can find some other deals that have come to a final sort of tally. Doesn't do a great job of sort of showing you how much money people made in those deals, but it does at least give you a list of some of the interesting exits that have happened in the Southeast over the last 8 years. And as an investor, that's also a useful thing to keep in mind, as ultimately we want to know what the exit opportunities are for investments that we make.
I think that's a very interesting dilemma that we have, where in the private investment space or private capital space, that there's not enough information that people can see what's going on. So there's not enough transparency. And it's hard to invest when you don't know what's going on. I shouldn't say it's hard. It's troubled investing when you have limited data. And that's one of the big issues with early stage investing and really growth stage too, is you don't have firm data on these private companies because they're not required to report. And I'm just wondering if there's some regulatory way to require some kind of minimum data from these private companies in order to raise money that is made public so that investors can get some kind of idea of what's going on. And I understand the logic for privacy because you don't want to give your competitors an advantage. I understand that. But there's got to be some middle ground for the regulators to require some public disclosure on these private companies that are raising money and some basic information like, hey, how much money did you raise? And how many investors were there? Maybe it's as simple as that. And
Yeah,
maybe
well,
it's at what valuation. And so then if there's a second round, you have a comparison tool available.
yeah.
I
So
don't know. What
they're
do you think
actually
about that?
interesting that there are a few places where there are rules around that already. So if you do a crowdfunding, a campaign, a public fundraising, you do have to show some of those financials, depending on the size of the fundraising you do. You have to get audited financials and publish them. So in some fundraising rules, those things exist. Even on the B rules that we're talking about here, that angels and VCs do, you're supposed to file your Form D, which says how much money you raised. So at a very basic level, that information is supposed to be out there and public. It's diffuse and hard to get, and people don't always fill in the forms. And that's part of the reason that PitchBook data is good, because it uses some of those materials. It also can't fill in the gaps on all those materials. So that's why it perhaps doesn't have the full coverage. But some of that people are doing.
What fraction of fundraising in the United States do you think actually files a Form D?
I don't think we know that. It is that you are supposed to. So it should be 100%. My guess it's probably about 50% maybe, just based on informal conversations and fund or investments I know have happened that I can't find a Form D for. I would guess about half.
The interesting thing about that is there's already a path. And so if the SEC were to change their definition of an accredited investor, it would be an opportunity to tighten up that regulatory thing, particularly in the era of AI, where you could actually mine that data very easily.
Yep.
So make it a quid pro quo where, okay, we're going to loosen the definition of an accredited investor, but in return, these deals have to provide some transparency reported to the SEC in a way that it can be scraped by AI algorithms. And then you can get current up-to-date information, some information. I mean, obviously, it's not going to be diligence information, but it's going to be an idea of what's going on in the market.
That would definitely be helpful for market practitioners. That would make this report, I think, even better if they had access to that kind of information. There's other things that I've mentioned already that they could do to improve, I think, this report, but that would give them a good boost on the quality and the comprehensiveness of the data that goes in.
Yeah, I think the best thing they could do is get a couple of partners that provide data separate to what they have access to strengthen their overall data. So they could create a report that's more comprehensive and useful by having more partners. And I would encourage that. So what's the bottom line takeaway from this report for listeners? Should they read it? Should they just listen to our assessment?
Yeah, I don't rely on anything I say, so definitely go read the report for yourself, see what conclusions you come to. You'll find some useful data in there, even outside the trends analysis that you can use. So definitely would recommend people use it. We should link to it in the show notes and publicize it a bit, because it's good that somebody's tackling this. So overall, I'd give it probably a B or maybe a B- overall. But that's a good start because nobody else is really trying to do this. So definitely encourage people to go read it and see if you can get any useful things out of it for yourself.
Yeah, it is an information vacuum, so any information is useful. All right. Well, thank you, Paul, for your insights in that, and thank you for your comments.
Thank you for listening. Visit us at ventureinthesouth.com for a complete list of previous and future shows.